Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today on Amazon or by going to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, well, we can pretty much cover it all. Now, that said, please remember this is just a show. Everything you hear should be considered informational, as in not financial advice. If you want personalized financial advice, request your wealth analysis by going to www.yourwealthanalysis.com. With me in the studio today, Mr. David Franson. David, thanks for being here.
Yes, glad to be here.
David's going to be reading your questions, and I'm going to do my best to answer them. You can text your questions in at any time this week to the number. Save this, put it in your phone right now, 913-363-1234. Again, that's 913-363-1234. Or you can email them to heymike@howtoretireontime.com. Let's begin.
Hey, Mike, if I fund my reservoir, can I afford to take more risk with the other parts of my portfolio?
Yeah, absolutely you can. What's the point of a bond fund?
Yeah, I mean, supposedly so that you have safety, preservation, right?
Yeah, so I know we kind of already covered this a little bit, but I want to dive a little bit deeper into it,
Yeah,
especially
okay.
for our podcast listeners that get a segment every day.
Yeah.
Which, by the way, if you're listening to this via the radio, we're a podcast. Just search for the podcast, How to Retire on Time. And then you can get this show in little daily segments. It's about 10 minutes every single time.
Yeah.
It's so powerful. Listen to it as you want on your own time. But okay, enough with my shameless plug. The answer is yes. And let's just define things. What's the point of a bond fund as a part of your portfolio? So Harry Markowitz, who, by the way, created this whole 60-40 split concept, who won a Nobel Prize for it, didn't even use it. He did other things with his investments, but the idea is simple. If the markets crash, there's a high probability that interest rates will go down. If interest rates go down, there's a high probability that bond funds will increase in value. Okay, they're not tied directly like with each other, but there is an influential correlation with that in most situations. But it's not always true. So if inflation's an issue, the markets crash, the Fed might not move anything. So if you look back for the last couple of years, the markets were going down and bond funds were going down at the same time because the Fed was not dropping interest rates like they did in 2000 or 2008. So we need to understand that bond funds have risk. But the idea is, in normal situations, if the markets crash, if your equities, your stocks go down, your bond funds could increase in value. If you want to do a fun research project, look up on the internet what bond funds did in 2008. They made a killing. They were awesome.
How about that?
But you wouldn't know because the equities went down so... I mean, it was bad. But the point being here is bond funds have their place, but there's risk associated with it. But if you're putting, let's say, 50% of your assets into bond fund alternatives, like a CD, like treasuries, not treasury funds, but like treasuries,
Okay.
or you put assets into fixed or fixed indexed annuities, or you funded a good amount of money into a cash value life insurance like Index Universal Life, or whatever it is. That's 50% of your portfolio that can't lose money but still has growth potential. That's not bad.
Yeah.
So the rest of it, in my mind, would allow you to take some more risk because you've got to look at the portfolio as a whole, not just, okay, I have this account and this account needs to be allocated this way, but I have this account for these products and I'm not going to look at it from a comprehensive standpoint. I'm going to silo it a little bit. I'm going to segment it and not consider the other thing. Look, the reality is everything you have, your assets, your investable assets, so not your primary home, but all the other stuff, those are resources to generate income in retirement. And there are 10 ways you can generate income in retirement. You've got, now here are the key ones. You've got your Social Security, if you qualify, most people do. You've got your pension. Some people have pensions. You've got rental income. You've got income from growth, income from dividends. You've got income from annuities. The list goes on and on. There's a lot of ways you can generate income in retirement. But all of those different ways and different strategies would require different allocations within your portfolio, and you need to hedge against them in different ways. So like if you have a bunch of real estate portfolio and the real estate market tanks, there are different ways you're going to hedge against that as opposed to different ways you're going to hedge against a dividend portfolio, because dividends aren't guaranteed. If you look at the 2020 Corona crash, there were many, many companies that just stopped their dividend. So how do you get through that? How do you hedge against that? Again, it's context here, but the question is, can you fund your reservoir and take more risk? Yeah. But you need to understand first, how are you going to take income from your portfolio? How much of reservoir do you need? And what types of reservoirs do you need to back up when markets go bad? The reservoir strategy is real simple. Just like a city has a reservoir of water in case of drought or fire or whatever it is, they have the reservoir of water. They keep it full for times of need. The reservoir in all of its form is there for when the other things don't work out. I say things because it's not just markets. It could be a number of different life events that you just need extra money that's in a protected place.
Yeah.
I don't know if people fully understand the importance of this because they think, well, I'm diversified, that's good enough. Oversimplified plans oftentimes, in my opinion, take on additional unnecessary risks because of the oversimplified approach. That's why the details matter. That's why a comprehensive analysis or a comprehensive plan makes sense. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcast. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.